Alright folks, we're back, and now we're going to discuss monthly to weekly today, right? Next week we discuss weekly, daily, and then finally we discuss daily into intraday. Now, I don't want this to be a waste of my time and your time, right? Because, to be frank, I don't need the money, right? I would much rather, if there's a bunch of you who succeed in applying these concepts from all three groups, of course, right? The previous two ones and this one. If there's at least half of you, because that is a pretty difficult number. As we know, 90% of traders lose. So if there's half of you who can successfully apply these concepts, then for me, it's a success, right? That is my parameter. So I would really like you guys to not skim over this and actually study what's being said, right? Because it's how the markets move. Now, DXY. The entire year was spent in a consolidation, right? Let's mark the year out into quarters. January. April. And 1, 2, 3, right? Now, what happened here? What happened here is each quarter represents a candle, all right? And before we even go into that, we have to remember that every 3 to 4 months, there's a change in sentiment in order to bring in liquidity into the markets, right? Because if the markets were always trending upwards forever, then everyone would make money, and that's not how it works, right? If they were always trending downwards, non-stop, in a straight line, then everyone would make money. And that is not how the markets work. If they were always consolidating in a range, then it would be too predictable, right? Which is range high, range low. It'll create a certain pattern and people will catch up to it, right? So there's always a shift, a shake of the markets every 3 to 4 months, right? Which is what we're trying to catch when we speak about a higher time frame swing move we're trying to capitalize on, right? So, divide the year into quarters, as we have been taught, right? And it is one thing to be taught something, and it is a completely different thing to execute on that thing, right? So what happened here was, let's go to the monthly first, right? The monthly on the dollar, from a simple PDRA perspective, premium discount, right? You pull a fib, low to high, right? We're sitting at the 50%, and the 50% of any price leg, right, is an important key level. The 50% of a ranging market is a key level, right? Write that down. So, at the 50% of a price swing or a key level, I expect to see some sort of accumulation, a turtle soup, at or around the 50%, and then a continuation of the trend, All right? And that is precisely what happened here. We are lying at the 50% of this price leg, right? This low that broke the high, right? This is clearly a break of the high. So we're breaking highs, and we're smacking back down into the 50% in the old high, right? So here we have an FVG below the 50%, and FVGs below the 50% level or at the 50% level are an excellent continuation PD array, right? If you limited your entries and exits and trade ideas only to the premium and the discount key levels, then you would eliminate a lot of losing trades, all right? If you go back right now in your journal of the last week, for example, then you'll notice that any loss you took probably had that as a factor that played into it, right? Which is you didn't measure, are we high, are we low, right? Remember from level 1, those who were there. Anyway, we have here a gap created by this down move, which is also from a key level, which I'll let you find out. And if you're a trader trading the charts, you should know it anyway, right? There's nobody who's trading ICT or trading the dollar should be unaware of the key level that caused this retracement, right? So what happened is that we have a gap, an FVG at the 50%, and we have accumulation happening at the 50% at the gap, right? We also have a gap formed from this sharp retracement leg, and sharp retracement legs are usually retraced at least 50% or more, right? So we have this framework of gap to gap. We have this gap to that gap, which is the a model which I'll introduce to everyone later on, which is the gap to gap model, right? Gap here, gap here. So we can we don't need to know what happens up here, right? We only know the following, which is what matters to us, which is we have this gap and we want to take price from this gap to this gap. That's the whole game. Whichever one gets hit first, we take it to the opposing gap, right? That by itself is a model, right? So a more precise process would be, we're just going deeper into it, right? We have this important low over here. As we know, it's all about highs and lows and imbalances. So we have a low, and look at the significance of the low. You're always trying to target a low and always trying to enter from a low, using the low as a pivot point, right? Using this low as an anchor point to price. It'll either break it or it'll use it to continue higher. That's all that's ever happening. There's a high, there's a low. It's either being broken to shift the trend, like here, or it's being used to control price as an anchor to continue the trend, right? Now, what happened here is that excuse me, this gap was not hit over here. Very good. So we've been accumulating in a tight range for 6 months. Now, what does this build? When you're accumulating in a range for a long, extended period of time, it creates interest on both ends, the upper end of the range and the lower end of the range, right? This is the model I use most to enter and exit trades is the simple range theory, right? Range high, range low. They're using this range to create interest in the market, right? So they're purposely contracting price in a small space to create interest, and then they smack into one end, and the first break of a range is usually almost always a fake one. Break in the range and go higher. That's all that happened, right? Ignoring this FVG, ignoring these quarters, right? That's all that happened. So we wait for the accumulation. Now it did manipulate over here, right? This would have faked a lot of people out, right? And it did, which is was this really enough? Was this enough of a manipulation? Because usually the strongest reversals, right? This is an important one. The strongest reversals of major swing points happen with closes above the high or below the low to sucker in as many people as possible, right? Precisely like this, right? It's either a close or consolidation at or below the low or high, right? And that is that goes into low resistance tops and bottoms, a topic for later, right? There's a lot to cover. However, for now, right, just note that strong reversals come from deep candles closing and digging, thick bulky candles closing and digging into highs and lows, right? So we closed below this low, right, once, and we never closed twice below the low. And this is where you were warned that this is the dollar bottom, right? If you remember, I came precisely right over here in this candle that dug below the low. This is the bottom based on this simple theory, right? So at accumulation, manipulation, starting here and ending here, and then distribution, right? AMD, power of 3, which is frankly what all concepts boil down to, right? Accumulation, manipulation, distribution. The same exact. Now, why does it matter that this dollar analysis was so perfect? Because this analysis of the dollar, right, if you use inter-market analysis, this offered 2 massive swing trades for this quarter, right? If you were paying attention, right, you could have milked this entire swing in both USD CAD, right, and Euro USD, right? Those are beautiful, massive swing trades, which are quite frankly all you'll need in 1 year, right? If you divide the year in these 4 quarters, right, then all you need is to catch one of the quarters swings, right? And we caught this on Twitter. We caught this one from here to here, right? And we caught this one, right? This one, there was signs of accumulation because price had dropped massively, and then it sprung up. And when price drops with with a high volume, sharp, trendy drop, then usually the first bounce is always corrected completely, right? So that's what happened there, right? So leave this part out. Plus, it's the first quarter of the year, which is usually best left untraded. Same as Monday, same as the first week of the month, and so on, right? So leave this. We caught this, and we caught this. You only need to catch one of these swings per year, right? Especially if you're into asset management, right, of large funds, then you only need one of these and you're set for the entire year, right? And I'll go in depth on both USD CAD and Euro USD in the coming days, right? That's the main point, right? Which is we accumulate, we manipulate, and we distribute. Now, the interesting part to me today is to discuss what happens after this. From the manipulation, from the end of the manipulation, which is the start of the distribution, until the target is met. All right? That is what matters to me most. Right? Because this is how to think about it in a robotic manner, right? Which is in a market maker model, for example, right? Which, by the way, is taken from Wyckoff to all the ICT fanboys, right? Of course, he did refine it, but the idea of the market maker model, if you go back, study some Wyckoff diagrams and you'll see exactly where that came from, right? That being said, during a market maker model, a buy model, right? Price is going to keep going down and down and down until a certain point in time. Now, that certain point in time changes everything, right? So as soon as this happens, right, you have switched to a buy model, right? And you complete the buy model through the good old lens of accumulation, manipulation, distribution, which happens all through this, by the way, right? Accumulation, manipulation, distribution, accumulation, manipulation, distribution, accumulation, manipulation, distribution, and so on, right? It's all in the power of 3. The market structure break is also part of the power of 3, right? Accumulation, manipulation, distribution. Distribution is the break in the market structure, right? So you have one leg of distribution, you have a retracement, and you have a second leg, right? That by itself is another model, right? And this is not a in-depth discussion of market maker models. It's a rough, extremely rough depiction, right? Which doesn't do it justice. I will be talking about market maker models in the future as well, right? However, the point I'm trying to make is that there's a certain point in time at which the trend changes from bearish to bullish, right? There's always an order block at this certain point in time, right? Always. There's always an engulfing candle. There's always a candle digging into this low, right? Candle digging into the low. The same candle being broken and retested, right? Where the traders mitigate their positions. Price doesn't mitigate, traders mitigate their positions, and then it flies off, right? So when you're trying to buy over here, right, ask yourself, am I at a certain point in time where the trend has changed or no? Using the tools which I have described in level 1 and level 2, right? So what happened over here? This candle digs into the low, right? As soon as this happens, as soon as this close happens, I start to get interested in the trade idea, right? As soon as this happens, now I'm interested. Accumulation, manipulation, and everyone is bullish down here, right? Remember? Exactly. Like, I don't blame them. The way they've been programmed by good old ICT, right? Whether it's intentional or not, I don't know, right? We can all have our theories and speculations, but one thing is for sure is if you follow market structure blindly, you will never make it, right? You will always suck. There's a logic to it. There's accumulation, manipulation, distribution, open, high, low and close, open, low, high and close in this case, right? So we close below it, right, into a higher time frame key level. Now this alone is an entry signal, right? And there's multiple ways to enter a turtle soup raw, like this one right here. One way is to simply enter with a limit at one end of the range, a stop, which is going to be 1/3 of the range, right? Conservatively, you go high half the range, right? This will increase win rate massively and decrease your risk reward, right? But this is probably the highest accuracy method of trading a range ever, right? It's not the most risk and reward. That is another method, which I will be discussing later, right? Or maybe not. But this is definitely the highest accuracy model of range trading. It's boring, but it works, all right? So, following that simple model, you go and it rarely fails, right? If it fails, then you are choosing the wrong time and the wrong range, right? So what happens after this one point in time where the bottom forms, right? Which is right over here. Remove this, and keep this, all right? You go into the weekly. So the monthly is staying up, right? Now, for the weekly to confirm me bullishness, I have two options. I have the classic ICT option, which is waiting for it to close above this high of this candle, order block, right? Change in state of delivery, which is the candle that digs in the low or in the high. You wait for it to close above it, and you've confirmed your sentiment, right? So from this moment onwards, we're bullish on the dollar till here, right? That's one way. Another way is to wait for it to close above the breaker, right? Now we're bullish, right? And another way, which is not discussed a lot, in fact, I haven't seen discussed ever, is closing inside the low again and retesting the low. As soon as we close inside the low again, then as soon as this candle closes, right, then that is your entry signal, right? Now this is a technique I've never discussed before, right? So note it down and test it, right? And it'll almost always, what happens is as follows, right? You have the low, you have one candle closing below the low, and then it closes back above the low. This is the bottom, right? And then over here, and it keeps going higher, right? With a potential for a wick, right? So this is another entry model of range trading.